Welcome to Global Markets Daily Brief. I am Jonathan Simkowitz. It is Sunday, February 22nd, 2026. Every headline this weekend says the Supreme Court struck down tariffs. But that is not the question that matters for capital allocation. The question that matters is this. If the administration can reconstitute roughly the same effective tariff rate through alternative legal authorities, then what exactly did the court change? And more importantly, what happens to the bilateral trade deals that were negotiated under the old framework? Deals with South Korea, the European Union, India, the United Kingdom, and Japan that were built on a legal architecture the court just dismantled. That is not a constitutional question. That is a repricing question, and it is one the market has not yet fully answered. Here is what happened. On Friday morning, the Supreme Court ruled 6-3 that the International Emergency Economic Powers Act does not authorize the president to impose tariffs. Chief Justice Roberts wrote the majority opinion, joined by 2 other conservatives and 3 liberals. This struck down the sweeping reciprocal tariffs originally announced on Liberation Day last April, tariffs that had generated over $133 billion in revenue through December. Equities rallied on the decision. The S&P 500 gained roughly 0.7% to close near 6910. The Nasdaq led, up nearly 0.9%. Consumer discretionary and tech, the sectors most exposed to import costs, outperformed. The dollar initially spiked, then reversed lower. 10-year Treasury yields pushed up to 4.09%. The Russell 2000 whipsawed and actually closed lower on the day. Then, within hours, the president announced a new 10% global tariff under Section 122 of the Trade Act of 1974. By Saturday, he raised that to 15%, the legal ceiling under that statute. That is the first-order reaction. Let's step back. The consensus framing this weekend is straightforward. The court clipped the president's tariff powers. Markets rallied. Tariff uncertainty has been lifted. This is broadly correct, but it is also incomplete in 3 important ways. First, the Section 122 authority has a hard legal constraint that most coverage is underappreciating. The statute allows temporary tariffs for 150 days. After that, Congress must act to extend them. That clock starts ticking on February 24th. 150 days from now lands in late July. That means we're not looking at a permanent tariff regime under this authority. We're looking at a bridge. The administration has explicitly said it will use Sections 232, 301, and 338 to rebuild country-specific tariff structures during this window. Treasury Secretary Bessent told the Economic Club of Dallas that the result will be, in his words, virtually unchanged tariff revenue in 2026. Second, and this is where the real repricing risk lives, the bilateral trade deals negotiated over the past year were constructed on IEEPA authority that no longer exists. The European Union agreed to a 15% tariff framework. South Korea agreed to lower rates from 25 to 15% in exchange for $350 billion in investment commitments. India reached a framework deal that lowered its rate to 18%. The United Kingdom and Japan agreed to reductions in the 10 to 15% range on autos. Every one of those agreements was anchored to a legal authority the court just invalidated. South Korea's presidential office has already said it will review the deal in the direction that best serves national interests. India's framework is being reassessed. The EU is signaling a coordinated European position. These are not confirmations that deals will hold. These are signals that renegotiation risk is live. Third, the market's reaction on Friday was remarkably well behaved. J.P. Morgan's trading desk had pre-circulated a probability-weighted playbook assigning 64% odds to exactly what happened. Tariffs struck down and immediately replaced. Their projected outcome for that scenario was an S&P 500 move of +0.1 to +0.2% after an initial spike. The actual close was +0.7, modestly above their central estimate, but within the broader range. This tells you the ruling itself was priced. What is not priced is the renegotiation cycle, the 150-day clock, and the fiscal revenue gap if replacement tariffs underperform. My base case is this. The effective tariff rate facing U.S. importers does not fall meaningfully over the next 1 to 4 weeks. The administration will move aggressively to reconstitute country-specific tariffs through Sections 232 investigations and Sections 301 actions. But the transition creates a window of genuine uncertainty, particularly for export-dependent economies like South Korea, where trade represents 85% of GDP, and for sectors still carrying Section 232 duties, such as autos, steel, copper, and semiconductors. The equity rally on Friday reflected relief on the headline. The bond market, with yields rising, reflected something more nuanced, an expectation that the growth and inflation picture has not fundamentally changed. Consider three scenarios over the next 1 to 4 weeks. The base case, which I would assign roughly 60% probability, is that the administration successfully begins replacing IEEPA tariffs through alternative legal channels. The effective tariff rate stays in the range of 9 to 12% on average. Trade deal partners accept revised frameworks with modest adjustments. Equities consolidate near current levels. Volatility compresses slightly. The dollar stays range-bound. This is the orderly transition scenario. The bull case, maybe 20% probability, is that the 150-day constraint and legal complexity create enough friction that the realized effective tariff rate drifts meaningfully lower over the spring. Companies begin to recoup some of the estimated $170 billion in duties already paid. Consumer-facing sectors re-rate higher. The Fed, seeing reduced inflationary pressure from trade, signals more room for rate cuts. Risk appetite broadens. Small caps, which have lagged badly, begin to catch up. The bear case, also roughly 20% probability, is that the renegotiation process breaks down with one or more major trading partners. South Korea walks back investment commitments. The EU adopts a more combative posture, as France's finance minister has already hinted. The administration, facing a revenue gap in the big beautiful bill that was relying on tariff income, escalates Sections 232 actions more aggressively than expected. This reintroduces the same policy uncertainty that suppressed non-tech capital expenditure through all of 2025. Bond yields rise on fiscal concerns rather than growth expectations. Equities give back Friday's gains and then some. What I would watch closely over the next 2 weeks is first, any concrete executive orders or Commerce Department filings that begin to formalize replacement tariffs under Sections 232 and 301. The speed and specificity of those filings will tell you whether the orderly transition scenario is on track. Vague language and delays would tilt the probabilities towards the bear case. Second, any official statements from Seoul, Brussels, and New Delhi on whether existing trade deal commitments remain binding or are subject to renegotiation. South Korea is the most important signal here because of the size of its investment commitments and the sensitivity of its export economy. If South Korea signals that the deal framework remains intact under revised legal authority, that's a strong confirmation of the base case. If South Korea opens a formal review process, that's an invalidation signal. Tuesday's State of the Union address may also offer clues. The president will have a national audience to frame the replacement tariff strategy. Watch for specificity on timelines and legal authorities, not rhetoric. Q4 GDP coming in at 1.4%, well below expectations, and core inflation running above forecast in December are reminders that the macro backdrop is fragile. The tariff story is unfolding against an economy that was already decelerating, with sticky prices. That combination narrows the policy margin for error on both the trade and monetary fronts. This is market commentary, not financial advice.